Good to see you back. You know, it's great to have you. You were used to be on the show, and now you're on stage with us. So
yes, great to be here. Thank you for having me.
So, yeah, by way of background, some of you were there, last year, albeit, in a different location. We had a very good discussion with Dennis Coleman over there. That was a few days after his earnings at Goldman Sachs, and it was all about asset management and the private market, and effectively 1 year later, effectively, it's an evidence that the growth, the development of the private market is now something that is top of mind. It's every day, in the papers. And I thought, and thank you for accepting to, join us, Sonali, that having your perspective, that will bring not the institutional perspective we had last year, but the private, the retail, the wealth perspective, and you'll be telling us much more about that. So, by way of quick introduction, and I'll hand it over to you. Sonali is the chief investment strategist at iCapital, and she'll tell us, a lot about iCapital, which is, a fintech leader transforming access to alternative investments. You lead, in this role, the strategic development across public and private markets, obviously. Prior to joining iCapital, as I was saying, Sonali was an anchor at Bloomberg Television and leading the global finance team over there. I had the opportunity to meet you over there. You had me on one of your show a few times, and so it's, it's somehow weird for me to be in this reverse and to interview you, but I was looking forward to it. Your newsletter, Wall Street by Basak, is one of the most followed and read, in the streets, and I can testify on that. And more recently, that was, the one series that I encourage all of you to watch on Bloomberg. You created and hosted, Bullish, which is a docuseries spotlighting influential voices in finance, and you've got 6 episodes?
6 episodes, a half an hour each.
For the first season, and I'm telling you, that will be better than Netflix, for the weekend. So, bottom line, you've built a reputation as one of the most insightful voices in financial journalism, and now you are on the other side. So let's start there, Sonali. First, why does someone leave Bloomberg to move onto the fintech side? I don't know how you want to define iCapital.
Yeah, it's interesting because Bloomberg was a large financial technology firm, and so is iCapital. So I do see a lot of similarities. You think about it, I spent the last 12 years at Bloomberg covering the evolution of private markets. And this move into what a lot of people are calling retail investment in private markets, we like to think of it as individual investors. We don't love the word retail, but, this movement is so massive. We're seeing it in real time. iCapital just surpassed $1 trillion worth of assets on the platform. We are now international. We're opening 2 more offices in Abu Dhabi in the next month and Sydney as well. So that global view of this market, we have public and private markets. That was also important to me to see across the entire investment spectrum and to be able to communicate with investors directly. There is a sense of a journalistic approach to my strategy that I'm doing because you just ask tough questions. And I think that's a very important aspect of this when you're bringing individual investor money into these funds. Because they are private, you want to make sure that we are doing top-notch research, getting answers quickly, and not assuming that these markets don't change just because they're private.
Yeah, and I'm sure we'll get into that because, I've certainly been there, long enough to see cycles. And sometimes there are many questions around, is wealth, private investors getting sometimes, too late into some of these investment strategies, and there is no shortfall of press and media over the past few weeks, so we can, elaborate on that. But you say, getting to $1 trillion, iCapital is a fairly young company, but one of these transformative platforms in the industry. The industry has been changing a lot. We had the opportunity, at this forum to discuss in the past. And how would you define the role of an iCapital platform between the managers, effectively the people who are running the strategies, and your ultimate clients? What's your day-to-day at iCapital?
Sure. So it's interesting because across private markets, it's a broad space. And that's everything from secondaries, both private equity and credit, secondaries, real estate, private equity, infrastructure. And so there's a huge world out there, and every client has a different set of needs. At the same time, these are not liquid funds. As much as these funds are starting to become what they're calling semi-liquid, it's not the area of an investment portfolio that you want people to put money in and then think about pulling it later. It's the money you're supposed to set and forget and have some comfort that it's there. So what happens then is there is a little bit more of a learning curve for a lot of people. So my day-to-day is we have a wide range of investors from some of the largest banks on the planet to RIAs across the country to different forms of individual investors in different countries. So my day-to-day is bringing those investors' needs around those different asset classes to the fund managers themselves also. We do a lot of work talking to different fund managers of, okay, well, our clients don't really understand this, or they don't understand how what you're doing fits into their portfolio, even if it's a great performer. Yeah. At the end of the day, it's a total portfolio approach. If you're going to take illiquidity risk, then what are you doing it for? And the income enhancing part of that is something a lot of people love, a diversification with markets at all-time highs now, nearly all-time highs. We've pulled back
Public
a bit.
market, you mean, right?
Public markets, correct.
We can talk about valuation in the private market.
We can do both.
Because there's obviously a lot of talk about that. So in a portfolio construction nowadays, if you take maybe here in the US, which is the core of iCapital, but obviously given the audience probably interested to hear about also about what's happening, let's say in Europe. What's today the average allocation to private equity, private debt, real assets, infra, of any given client here in the US?
It's interesting. It's not very large, right? It could be low single-digit percentage points. When we talk to the financial advisors that work with a lot of these individuals, they say it could be larger for especially higher net worth individuals. There's a huge drop-off. So if you look at, for example, registered investment advisors in the United States, the ones that have more than 500 million in assets tend to have larger allocations per advisor. So 50% of those advisors on those platforms, but among their clients, it ranges widely. Some are very comfortable with it, some not as much. But then when you go anywhere between 25 million and 500 million, it's somehow the same, roughly a third or less of the advisors than of their clients, say 2%, right? That can get a little closer to 6% in the near term, they think.
Okay. And so the next frontier, 401k. Tell us about 401k and what's at stake for you and for the industry.
Yeah, and as you know, of course, there was that executive order that really charged US regulators to go look at how they can start creating some sense of guidelines on how this industry can really form. Now, this is really interesting. There's an interesting opportunity here simply because when you're thinking about retirement, you're thinking about the long term. This is not money that you want to pull out. This is money that you want to let grow. So it should be a perfect match. But certainly there's a lot of questions, concerns about lawsuits, for example, about the liquidity profile, which confounds me a bit because you don't want necessarily these to be very liquid per se. But starting next year, we think this is going to be a bigger and bigger conversation. Yeah. In the near term, we think that the advisor community is going to be more of the driver behind that force into private markets.
So here's maybe a tip for you. Last night, one of my partner in Paris, was writing us something in the context of something we should be discussing, the noise about some people restricting the liquidity that is otherwise supposed to be available. And he said, we should redefine ourselves. People like at TKO and others, we're no longer an asset manager. We should be an asset and liability manager. And I found that, fairly, he's the smartest of the gang. So, but I found that very interesting because when you talk to the driving forces of our industry, and you all know them extremely well, they're effectively moving away from the traditional LP, GP structure that we knew 10, 20 years ago of these closed-end, drawdown private equity funds. And they are becoming much more creative in effectively managing all the types of liabilities, insurance, obviously, wealth and privates. And I found that extremely interesting to approach it that way. Because at a time where people and the industry, you've been commenting on that, years, in your previous life about, people going passive on the debt, on the bonds, on the equity portfolio, the ETF, quote unquote, cheap style of management. And then the private, barbling a little bit, this approach. And I found that effectively the liquidity aspect you just mentioned, and being not an asset manager but an asset and liability manager, is maybe something you should work in one of your letter. That's perfectly designed for iCapital.
Absolutely. There's one that I just saw from Ares the other day that I thought was actually a great piece that they came out with, and it answers something we hear a lot from our own investors: the cost of liquidity. If you're taking illiquidity risk, you should be paid for it. So what benefit are you seeing from locking that money up for longer? And I've got to say, for all the headlines, we are hearing a tremendous amount of interest also, both from the fund management community, because they actually really like that there's so much scale able to be created among individual investors' money these days. And also the fact that they actually find the wealth community more reliable partners, because a big investor could come in and pull their money tomorrow or not invest in the next fund. Whereas a lot of these wealth advisors, once you start working with them, they become longer-term clients.
So, valuation, you're talking about the public markets valuation all-time high. I'm certainly not qualified to say that, but they're part of the market I certainly don't understand. And you read every day that there might be a bubble here and there. And then, if we move that onto the private market, so obviously let's start with the most famous of all, private equity. Then we can discuss, private debt. There's been this discussion for, almost a couple of years now, that there is a real disconnect between what is the perceived valuation of an asset on the private side and effectively the valuation you're getting when you're selling it, either by way of a secondary transaction or of an IPO, and there haven't been that many. I mean, the market is still somehow frothy. What's in your role as strategist at iCapital? What is your gut feel and the company's views as to this perceived gap, and are there any reasons to be concerned?
Yeah, this is one of my favorite topics, because there have been so many headlines about how opaque this industry is. And the only reason I like those headlines is because it starts a new conversation, which is that many managers are starting to provide much more frequent marks. Now, that can be as little as monthly now, right? And the more communication there is about the health of portfolios, the less afraid people actually get. For example, let's take the private credit cockroaches, as Jamie Dimon likes to call them. There were 2 instances that were actually bank-led deals, right? Then one instance that we saw that was a more pure private credit issue that we saw. But when you look across the industry, really, you're only seeing default rates still less than 2%. And when you look at the health of the underlying portfolios, you're seeing coverage ratios improve. You're seeing actually private equity-led deals are doing less bad than the ones not involving private equity sponsors. So why is that happening, and why is there such a big disconnect between how people feel and what's going on? We think the answer is transparency, and we're finding that more investment managers are willing to provide that transparency because their marks are actually pretty good.
Yeah. And very interesting you're bringing the cockroaches discussion. One of the leader of our industry that I know respect, I certainly do. Mark Rowan at Apollo, was saying, yesterday that effectively he was not seeing anything systemic, but only some idiosyncratic, as we call it. And by the way, just as a transition to the previous panel, and not to be the party crasher here, when one of these large cockroach, effectively hit the headlines. One of our, that this private credit that is being sold, through the market, syndicated loan market facility, and then CLO managers. And as a matter of fact, your previous company, Bloomberg, reported that the largest holder of this cockroach was a CLO manager that had advertised itself as an AI-powered asset manager. So the reason I'm saying that is that it's obviously there's a tool, but that will never replace effectively the good sense and judgment that people can have when they're dealing in private transactions.
The judgment is a very, very big part of this, and we like to hear from managers that they're active, that they're looking at their portfolio companies, they're working with their portfolio companies. Just to kind of provide a little more color on this, I think this is so important to remind people there will be losses. this is not a riskless proposition. Now, the scale of those losses, when we looked at the issues with the cockroaches, I think we had looked at more than 1,600 BDCs, and it was less than 24, I want to say 15 to 16, that had any issue at all with the questions and name.
Maybe, sorry, BDCs,
But business development companies. This is the way that a lot of people currently access the high-flying world of private credit these days, though the structures are changing. But if you look at actually the exposure that they have to the cockroaches, to the problems, most of them, this is an amazing, it's less than 0.01%. So just like putting this into perspective, how much there are huge headlines around this and what the numbers are actually saying. But we do think that there will be more and more dispersion, that there will be great managers that succeed through the cycle, and people will pay attention at this point in time as it's not that the cycle's turning, but there's a K-shaped economy in the US
100%.
where there are issues in the economy that a lot of these funds, let's face it, they are exposed to them and they will have to deal with it.
So in that environment and this market, what are the best sellers nowadays? I mean, what are your clients asking for? What are they picking up on the high capital shelves?
One thing that I think is so interesting is after years, you and I lived through it, private credit was the #1 thing everyone was talking about. For the first time in a year, we saw private equity actually surpass private credit. And we define private equity a little broadly. It includes growth equity and venture capital. Now, people are getting really excited about growth equity and venture capital because it is exposed to artificial intelligence. And it's not getting the same type of access as, if you invest in NVIDIA today, people are very worried. If you invest in any of the Mag 7, even from the beginning of the year to now, the Magnificent 7 names, the leaderboard has flipped. You're looking at Meta was your high flyer at the beginning of the year. Now it has become one of the worst performers because the narratives around AI has been changing so much. Now, investors are saying to us, well, we feel like we can get the same exposure in private markets in a perhaps safer way. So we're doing a lot of work behind the diligence behind those themes to see, is it true, right? Are they safer?
Yeah.
In some cases, yes, and in some cases, you got to do the math.
So we don't have the compliance disclosure, on the wall, but when you're on the road, I mean, what are your clients expecting as a return, or what are you selling, quote unquote, as a return when you get into this illiquid and private part of the market?
Absolutely. So it's interesting. We have this great chart. It's on my LinkedIn if anyone wants to look, where it is the dispersion among managers over the last 10 years. And we show the median IRR, right? This is just as a benchmark, to show just how well the best performers in each category are doing. So the median in direct lending was around 9%. So nobody's going to want a whole lot less than that, let's say that. If you want to look at where the top venture funds are performing, north of 20-30%, right? So clearly there are great opportunities to be had. The problem with venture is if you don't get one of those biggest funds, you're negative. So it's not just that you're underperforming the public markets, you're also losing money. So, it depends on the risk that you're taking on, but certainly, people talk about marks and volatility. Actually, the issue is that there's a huge divergence. The best managers are able to do well in this market, but there are a lot of people at risk of not being in those top managers. So our job is making sure people are able to get into the best of the asset class.
As always, track record, experience, and transparency. I know that you like this word, a lot. And when you use the word opaque, and I've been trafficking into this private market for some time, and it's something that at times, you feel that over the cycles when people get a little bit nervous. And we might be, in this environment because you're a journalist by background, and I found the everyday's headline being a little bit, coming back all the time on that. So, before letting you go, Sonali, I have one question that I think I asked last year to Dennis, although, slightly different. But you've been a market observer and strategist for years. On one side, of the equation, today you're effectively promoting some strategies. You've been working like crazy for these past, 5 years, and you certainly deserve a 1-year break. And before getting on your 1-year break, you want to, to monetize all your assets and pick one asset, for you to sleep at night. So would you go cash 100%? That's answer A. B, would you buy an S&P ETF and you forget about it? 3, you buy a put on NASDAQ. People are talking about valuation today. or 4, you buy a basket of PE managers, but that's the easy answer because that's what you do. So I will not give you 4. So just pick 1, 2, 3.
No, 2 things. I do not and cannot promote any managers. My job is to do the diligence to make sure that we're looking at the best places to be. But it's funny, as you know, back at my time at Bloomberg, I covered so many types of fund managers. One of them that always amazed me was Stan Druckenmiller because of the concentration risk that he took. I don't think that I have that kind of glutton for punishment. I'm a big believer in diversification, and I don't think that you could ever have 100% of your money in cash or anywhere near 100% of your money in private equity. So stay diversified. The market is still the market. You don't want to be out of the market. This is, especially in American markets, you know, you've seen how many short sellers have been put away in the last couple of years.
As always.
Yeah, so diversification, I think, is a key element of this, but also, you know, there's an art of compounding there, and then there's also an importance to yields that I don't think people are fully appreciating.
I agree 100% the compounding effect. So diversification and good sense. Ladies and gentlemen, Sonali Basak. Thank you.